you. Thank you both. So Malcolm, you want to kind of walk through the history of how sales tax has been taxed in this industry.
Yeah, I mean, it's been an evolution in the delivery format of software, right? And I can remember, although I don't remember actually seeing tape, I remember that software was delivered via tape and then discs and floppy disks and then CD-ROMs, but it was all tangible media. And then states generally would tax that as tangible personal property. I mean, if it was custom software, maybe there was an exemption, but it was tangible media. So it's taxable in every state, barring some other exemption. And then in the 90s, the electronic delivery or downloaded software, increasingly, the business migrated to that. I mean, sure, you'd still have some clients that would want a stack of disks to do a reinstall, if there was an emergency, but it migrated to electronic delivery, and states had to adapt their sales tax structures. Many of the states just included or modified their definition of tangible personal property to go from including pre-written software to including pre-written software no matter how delivered or transmitted. So, but delivered or transmitted is the key word there. So in the 90s, the states kind of trickled in how they were, going to basically shoehorn it into the existing statutes or change some of the definitions. Then in the early aughts, you saw the emergence of cloud-based software. And wow, how are we going to adapt now? Because the adaptation for electronically delivered software was no matter how delivered or transmitted, right? Well, cloud-based software is accessed. It's not delivered or transmitted. So that became an issue, right? And the states were like, well, we don't know. And then again, they either through new legislation or regs or frequently through letter rulings, again, kind of shoehorned it into existing definitions. Some states even came out and said it's not taxable. And there are still several, I think there are 18 states and some home rule jurisdictions that tax SaaS now. Of the 45 states that have sales taxes, I think there are 33 that tax downloaded software. Maryland was added back in 2021. Kentucky's coming up January 1st, 2023. And I think Louisiana is looking at it as well.
So only 18 right now of the states have it codified that SaaS is indeed sales taxable, or?
Yes, I wouldn't say codified, because in some cases it's a letter ruling, right? Or a series of letter rulings, and it's not really in the code. And when I prepare a technical memo or someone says, Malcolm, software is a service. It's a service. It's not taxable. And I guess they didn't get the memo, right? So they're like, show me where this is taxable. Frequently, the citation is a letter ruling and not a code statute or a reg.
Sorry to trip up your train of thought, though, but yeah, please proceed. So you're talking about Maryland just became 18th, 19th state to really have SaaS as access today as a sales tax.
Yeah. So this has been, I'm sure, all very riveting and thrilling stuff I'm talking about here. This is background. You need to have two things happen before you've got a liability, and that's what we're really here talking about today. Okay, I'm a SaaS company, fine. I love all this history. Great, I'll take my CPA. Nah, we're here to talk about why this is important for your business. If you are $1 million of revenue a year, maybe up to 5 revenue a year. Maybe this isn't a big concern. You're still scaling. You get up to about 5 million, 5 to 15. Maybe you start graduating from QuickBooks to Intact or some other ERP. You get your 606, your RevRec together, and you need to address your sales tax exposure, because if you are approaching potentially some sort of event, another round of funding, sale of the company, and S1, I guess, if you get big enough, although we see fewer of those these days, you're going to want to be due diligence ready, and you don't want any surprises. It's always the no surprises approach. When you're smaller, I don't want to, I've got bigger fish to fry.
Right.
You graduate and get a little larger, and there may be some event coming. It's something you're going to need to look at. It's just a matter of time and the magnitude of it, whether you address it now or address it later. You don't want to address it too soon, right? Because cost benefit, opportunity cost, right? You have other things you've got to take care of. The art is kind of when to do that. So you have to have two things before you're going to have a liability in the sales tax world. One is Nexus, which we're about to get to, meaning a sufficient connection with the state where they can make you collect their tax. And two is taxability. And that's what we were just talking about with the evolution of taxation. There's a similar thing going on with NFTs and crypto, non-fungible tokens. Right now, only 2 states have opined on NFTs taxability, Pennsylvania and Washington, and I think Minnesota may have come out with something just this week. That is another quickly evolving area where there is some uncertainty around, and of course, we're seeing a lot of NFT marketplace clients. It's becoming an issue. So there is an evolution, and the states, and I don't mean this in a critical way, but the states, there's a lag, right, behind technology as they adapt to new technologies and, adapt their taxation structure. So Nexus is the other leg for you to have that liability. What you're offering must be taxable in that state, because even if you have Nexus, if it's not taxable, there's no liability. But if it is taxable, but you don't have Nexus, you don't have a duty to collect that tax.
Right.
So
and California is a good example of that, right, Malcolm? So you may have Nexus, thousands of people in California and billions of dollars of revenue in California, but they don't tax.
Not taxable. That's right. And a lot of our SaaS clients are California based. I mean, they're all over the place. Right. I was Bay Area 20 years. I'm in Austin now. A lot of SaaS clients here in Austin, a lot of SaaS clients everywhere. But obviously a lot of them in California. And especially when they're earlier stage, California doesn't tax SaaS. So it's not even on their radar, right? And now we can kind of transition to Nexus, because prior to the Wayfarer Supreme Court decision in 2018, you had to have a physical presence in a state to establish that sufficient connection to have the Nexus required for the state to require you to collect their tax. Prior to, and the Wayfarer decision said, you don't have to have a physical presence. You can have an economic presence, and all the states rushed over the next 2 years, if you call that rushing, it is for the states, to enact their Wayfarer statutes, setting a threshold, most commonly 100,000 of sales or 200 invoices current or prior calendar year. So that was just a volume threshold, right? Prior to Wayfarer 2018 or 19 or 20, depending on when the state enacted their own statute, physical presence was required. That was the Quill decision from 92 that I remember. And it required that physical presence. Well, people think a physical presence is an office or an employee. And actually post-COVID, a lot of our clients have Nexus in more places, even if they don't exceed the Wayfarer threshold, because they have remote employees. So, but prior to Wayfarer, a common Nexus physical presence trigger for software companies yes, employees or offices, but if you have a large deals with large enterprise customers, you're probably not closing those deals over the phone, right? 6 or 7 figure deal, you have to go out, show proof of concept, meet with that customer, close that deal face to face. Visiting that customer for those sales activities is a physical presence for Nexus purposes. Back in the day, you would do implementation on site, right? Send the team out and do the implementation on site. That physical activity at the customer site is also a physical presence for Nexus. So those were very common Nexus triggers. People don't do implementation on site anymore. And after COVID, there's still a lot done remotely. But I also have some SaaS clients where we don't have large enterprise customers. They're $2,000 or $3,000 subscriptions per year, and it's small, medium business. We do it all over the phone. Okay, so maybe they don't have physical presence, but maybe they have more than they did 3 years ago because of the relocation of their workforce post pandemic, right, with remote work.
Malcolm,
so yes.
Could I just make a quick point here on that?
Please.
You know, we've seen in this I'm kind of referring it to as the diaspora of your employee base. How often do you see people who have not been able to kind of keep track of where all their employees are going? I mean, people move and they don't tell you that they're moving, and you only find out about it. Do you see a lot of that? Because I've seen it in some of our clients where it's like, oh, we had somebody move we didn't even know they moved there. Have you seen a fair bit of that, as I have?
Yeah, and I mean, just tracking where your employees are. So we do a lot of Nexus reviews. I mean, it's really a 3-phase thing. All right, you're big enough now. You don't want any surprises. Let's just look at things, right? Whether it's due diligence readiness or not. Do a Nexus eval, taxability analysis, and then a liability calc by state, so you know where your exposure is and if any of it's unpleasant, or whether it's just something to monitor going forward. So pursuant to the Nexus analysis, I'll ask for sales by state back to 2018, dollars, number of transactions, but I'll also send them a Nexus questionnaire. And on the Nexus for physical presence, right? Are you visiting customers in these states? Check the box, how many times a year? There is also, where do you have employees? And it's got it back to, 2018, 2017 by state. And the clients will call me on that one and say, how am I supposed to complete this? And I'm like, well, maybe talk to HR, or, you have a PEO. I mean, isn't there an inventory? Sometimes they don't tell them, but it's just a matter of time, right? Before they, I mean,
eventually it gets, but it's kind of like, I'm just trying to think of the best practice for identifying where people are. But for the folks listening, I mean, this is really important. You need to pay attention to where your people are for payroll tax issues. It just opens you up to all kinds of exposure. And, if people are, so I've even seen some of my clients send out a general email saying, guys, we think we know where you are, but just in case, if you've moved in the last 6 months, check that your address in our system of record, our payroll record, is up to date. And people are like, oh, I forgot to tell you, I moved to North Carolina, or I moved to Florida, or I moved to whatever. But this is real. I mean, I'm telling you, it happens. I see this every day. It's like, oh, surprise.
Yeah, thanks for bringing that up, Andy. I mean, just to remind everyone again that the scope of this webinar is sales tax, but you're absolutely right. I mean, the location of your employees can trigger payroll tax issues, income tax issues.
Well, and sales tax, because once you have Nexus, you have sales tax.
Well, right.
Potential sales tax.
Yeah, absolutely.
Okay.
So.
Yeah, thanks, Andy. So, and that's a good point. And because on that questionnaire, we're going to need to know what's the start date of that, the earliest employee. In other words, when is your first Nexus? whether it's economic or physical presence, we need to know the inception date. A, because if the state, comes to audit you, you'll want to know the answer. B, if you're doing a due diligence and the buy side Big Four firm comes in, they're going to ask, right? You might want to have that information ready and avoid the fire drill and at least appear like you've looked at this in the past, right? You want that study in the drawer. You don't want to tell the PwC guy, you don't understand, this is software as a service. That's not taxable. Because then they're like, all right, we got to move in here for a while. We're going to be a while here. So anyway, once you decide, okay, we're large enough now, it's on our radar. And again, because if I'm not saying it should be on your radar, you should be aware of the issue as the company scales. I'm not sure of the breakdown of our audience today. You want to be aware of the issue and make a management decision on when to act on that as your company scales, right? But if you do get to that point where I'd kind of like to know and not have surprises, or yeah, we might need to be ready in 6 to 12 months. So let's look at it now. Everything takes a while to do, right? So when we do the Nexus eval, that's the first step. Then we identify your offerings taxability. I've got SaaS clients that all they have is subscription. It's pure subscription. So it's one number and it's all taxable in the states that tax SaaS. I have others that have implementation services. And in some states, the degree of complexity with that implementation has a bearing on its taxability. And you may have support. I used to call it telephone support, but I think that's mostly online nowadays, right? So I also have clients where it seems like they're SaaS, but they have a platform, right? Everybody has a platform, right? So, okay, well, please send me your MSA. Let me see what the contract says about this platform. They may be software as a service, but it may be that they are providing an information service or data or research. And there's really just a dashboard that the customer signs into, runs its query, and gets its data or information electronically delivered. So it may not be SaaS, it may be data processing, it may be a canned information service. And there's a lot of overlap of taxability of those things, but there are some distinctions among states. So you want to make sure that you understand what bucket to put your offering in. And some of the services these days are increasingly complex. Is this some sort of network security service? Is this a background check? Is this an identity verification? All that can be done on a platform, right? But what's actually being provided? Information, or is it use and control of the functionality of that software by the customer? So it's really easy. Oh yeah, we're going to do the Nexus study, and then we're going to do a taxability analysis. And I know off the top of my head where SaaS is taxable, so that's going to be easy. Well, maybe even though you're telling me you're SaaS, and sometimes it's self-evident, sometimes it's not so much, right? Maybe we should look at those contracts. I had one client where the CFO told me, oh yeah, we're SaaS, Malcolm. Big Four firm said we were SaaS, we're SaaS. You don't need to spend any time on that. I said, all right. So we get in the middle of doing the VDAs, the voluntary disclosures, and it turns out they're actually infrastructure as a service. It was more like an Amazon thing. And I mean, it had operating software, but not application software. So it was IaaS, not SaaS. And it made a difference in about half of the states we were doing the VDAs in. And once you do a VDA and pay the state, you can't go, almost all of those agreements have a clause in them that says once payment is made and this is done, you can't come back and get a refund later because a customer came back with an exemption certificate and you'd be, coming back time and time. They're like, no, it's done, it's done. So you want to be careful about the taxability. And then once the nexus and the taxability is completed, you can pretty easily run a liability calc, prior period exposure, back to first nexus date, there's that phrase again, in each of the states that tax you're offering, and come up with a state-by-state spreadsheet for tax, interest, and penalty of your potential prior period liabilities. Couple of reasons you want this. Yeah, I know, no surprises is one. Your auditors may also want you to have an ASC 450 contingent liability calced and booked on your balance sheet, right, for financial statement purposes, especially as you get bigger, right? They probably won't look at it much if you've even had an audit, if you're a $1 or $2 million company, right? But if you're 10 or 15, you're probably getting audited financial statements, right, at some point. So the audit is one, and then obviously a due diligence readiness. You're going to want to be prepared for that and not have an ugly surprise. And frequently that's done at the last minute, right? Oh, by the way, they're asking for information about sales tax and want to know if we've got a Nexus study and a liability calc. They didn't see anything on the balance sheet. Now, you don't understand. How many times do I have to tell you? It's software as a service. It's not taxable. So, you want to be prepared, right? If you're large enough to where you're trying to get due diligence ready.
And Malcolm, to just interject a little bit, we had a good question from Monica Brar here in the chat. So could you be a SaaS in one state and then not SaaS or something else in another? And have you seen
Yeah. I love these questions. It's awesome. I like doing what I do. I love the SaaS space. And for some reason, I like sales tax a lot. So this is a great example of a classic question, right? SaaS sales tax. Okay, well, let's look how SaaS, back to the technical lecture here, let's look how SaaS is taxed in various states. In some states, most of them, I guess, where it's taxable, it's taxed as tangible personal property, which includes pre-written software. It's in the definition of pre-written software, or there is a letter ruling that says it falls within the definition of pre-written software. So that's not data processing, is it? That's software. But Texas taxes SaaS as a data processing service. They have a very broad definition of data processing that pretty much picks up every cloud-based service, pretty much, even pure data storage, right? So it's taxed as data processing. In Ohio, there's a little bit of ambiguity. There are two different taxing statutes. One is electronic data processing services. The other is electronic information services. And I think that definition includes access to computers. And I love the way some of these statutes are written. It sounds like it was something, 25 years ago. Computers, it's almost archaic language, but you work with what you got, right? So that's Ohio. Let's see if there are other exceptions. You also have gross receipt states, Hawaii, New Mexico. They don't care what it is, data processing software, whatever. It's taxable because it's gross receipts. Same thing with a Washington business and occupation tax. They tax Washington. Interesting. For SaaS, if it's just pure software usage by the customer, that's taxed as remote access software. But a lot of SaaS in Washington is actually taxed as a digital automated service, DAS. It's still taxable. It's just under a different statute. Just a little nuance there. And also, you are subject to the gross receipts tax called the business and occupation tax in Washington, reported on the same tax return as the sales tax.
So we get the idea. It's very, very complicated, and there's lots of and one of the questions that's being asked here is, have there been cases where the sales tax has resulted in large penalties or fines? Because when I look at it from the CFO standpoint, I look at it from, I want to be ready for the next thing. As we all know, there's the old engineering adage: you can have it good, fast, or cheap, but you can only have two of the three. So which two do you want? So your point on preparing ahead of time means it can be good and it can be cheap, but it's going to take some time, and you can do it, slowly over time, or you can do it the last minute. If you want it good, it's going to cost you a lot of money, and I get that. So from a preparedness standpoint, I think, the point is, when you start seeing some of these things, or you start getting to the point where you want to be always looking ahead to the next event. Am I going to do a financing round? If it's a significant financing round, I'm going to get due diligence questions about sales tax. I am. It isn't really that there's a big, I don't think states come after you and have huge fines and penalties as much, unless you're just obviously abusing this. It's more like you have to pay all these back taxes plus some penalties and interest that are not too crazy usually. But there is, the question is, how much is that liability? And if you haven't run the calculation, you don't know what it is, and you go into due diligence, and as a CFO, you sit there and go, duh, I don't know. Your financing will be held up until the question's answered. And then when you had it planned for September and now it's delayed until January, that can be catastrophic. So you don't want to be that person. I get all that. So the other kind of question I had for you guys to think about is, but you can answer the question first about, if there've been big penalties, and if there's an example of somebody who was just like out of control and paid a huge penalty and fine. But the other thing is, I'm struggling sometimes with some of my clients about where customers are located. Like I'm supplying it to somebody that signed the contract in Kansas, but the parent company's in Illinois, and the division that's using it is in Kentucky. And who's been different people have signed it in different states, have signed the thing. Yeah, where is it? The billing address? Where it? They pay their bills out of someplace of service in Florida. How do I determine where the customer is? So that's my second question for you after you do the big penalty one.
Andy, that is, man, these are just classics. As far as the penalty goes, state of Washington, you put an employee in the state of Washington, within 2 or 3 months, you will receive a business activity questionnaire, which means you're under audit, and they'll get all the Nexus information, Wayfarer and physical presence, and all your gross receipts information for Washington, and they will assess you tax, interest, and penalty. I've had some finance execs say, okay, well, we've got this $1 million liability calc. Let's just register going forward, start collecting. And if the state comes after us for the past, we'll just tell them, this has all been very gray area. It is a service, right? And we're not going to worry about the past. Yeah, well, you could do that at your peril. But the states will want their tax and interest. Interest is statutory, going back to First Nexus. And unless First Nexus was 15 years ago, and I mean, they're probably not going to, they could. There's no statute if you're not filing. But many of the states, if you don't come forward voluntarily, they will hit you with that 10 or 15, 10, 25, or 30% penalty. Some of the states, in my experience, if it's your first audit, you can get it waived, but I wouldn't count on it. And Washington's not waiving that penalty. And there are a couple others like that. So yeah, some penalties, some not, but it's not like it's going to be some 50% fraud penalty. But you are expected to be on top of the law, and it's not that gray, okay? I mean, some of the businesses, it's a little gray, but like I was talking about before, some of these platforms. But if the state determines it's taxable, ultimately, then, and the tax is due, then they're not just gonna forgive it, right? Just to be nice. The other issue you raised is a very good one. MPU, multiple points of use. And here's how that works. Let's say you're a big enterprise and you're based in New York. New York tax is SaaS. Contract address is New York. Doesn't matter where the billing address is. Cisco Systems is in Milpitas, and I think their shared services center accounts payables in Texas. So it's bill to Texas, but the contract address is California. California doesn't tax SaaS. So it's the contract address unless you have more detailed information. So multiple points of use. You're based in New York, you're a big enterprise, and your employees all over the country are using this stuff. So, but all you have is the contract address at the time you invoice them. Very rarely have I seen an exhibit or a schedule that at the time they pay, the vendor, the SaaS vendor, knows where all these users are. Okay, so we're going to collect all the tax, New York tax, right? Well, that's where the MPU comes in. In New York, the mechanism is for them to give you their New York users over their all users, a fraction, and you'll collect New York tax on that fraction. Some states have MPU exemption certificates. I think in Pennsylvania, you have to write in that percentage, Pennsylvania. Again, as the SaaS vendor, it's not up to you to collect in every state. I mean, that'd be a nightmare. And you'll avoid that nightmare as long as at the time you invoice them, you don't know. It's not written out on the statement of work or whatever. Washington and Ohio and Massachusetts have blanket MPU certificates. You don't even have to collect a percentage, but you do need to collect that MPU exemption certificate, and it'll relieve you of the liability. Sometimes, though, let's say it's a huge HR platform, right? Well, HR may be in New York at headquarters, so there's not an MPU issue. So you just have to look at the nature of your offering and the nature of how your customers are using your platform, if I may use that word.
Great. Thanks. I think it's a good time now to raise a poll question.
Yes, sir. I was just getting to it there, Nick. So we wanted to ask you guys, again, just get a feel for the audience. Malcolm talked a lot about those Nexus triggers a few minutes ago. We were just curious for the people listening in today, how many Nexus triggers do you have? There's multiple choice, multiple selection. Select as many are as relevant to you, but just wanted to get an understanding there. I'd be interested to see if Malcolm's insights of, post COVID or, whatever we're calling 2022, the impact on those, interstate customer visits and on-site training and implementation and such. All right, we got most of you here. Just give it another few seconds.
Good point from Corbin too.
Yeah, good point. The Wayfarer effect.
Right.
All right, let's see here. Yep, looks about right. Almost everybody saying they got a remote workforce or employees in multiple states. About half saying they've got a physical location in multiple, and then the lower two answers being those customer visits on site. Oh, here we go. Sorry about that. There we go.
Thanks. Yeah.
So here's probably a dumb question, but a question that maybe it's just not clear to me right now at the moment. But when we're thinking about Wayfarer and economic thresholds, and you were talking about that example where you're a big HR provider or something in New York, and you have that contract in California, but you might be billing Texas. Now, let's say you're a SaaS company and you sell to multiple customers, and those are billing addresses, so it's the headquarters. How do you look at that, and how do you know when you breach that threshold? Is it the same analysis in your prior example, and it's just that layered complexity, just having to look at each sort of contract by contract? Is that sort of what the approach would be?
Yeah, I mean, there are a couple of pieces to that question. Number one, the application, that always goes back to this. Two things, Nexus and taxability. For taxability, application of tax, it's going to be the contract address, unless, of course, you have more detailed multi-state usage location at the time you bill them, which is very uncommon in my experience. So for taxability, it's going to be that contract address, not the billing address. But then the question comes up, well, what about for the Nexus piece?
Yeah.
For the Wayfarer threshold, $100,000. Okay, is that bill to or contract address? Because the accounts payable people are paying me out of Texas. It's still going to be the sourcing for those gross receipts for the taxability and the Nexus analysis will be that contract address. So they'll be one and the same.
Okay.
So I think there is one good thing. Back to the polling question. One of the audience members said, well, it didn't include economic nexus. We actually should have said, which physical nexus attributes do you have? Because I have clients, especially where they are kind of an earlier stage, 5 million-ish. They're like, Malcolm, we don't exceed the threshold in many states. It's important to remember that it's not just all about Wayfarer. And, if you're relatively new to SaaS, then, and the whole, everybody's relatively new to Wayfarer, right? But some people aren't aware that, most people are aware that if they have an employee in a state, it's a Nexus trigger. Most people. And most people don't visit customers anymore, but that is a Nexus trigger. And I've got clients that do that. Some of them, especially for the large enterprise customers, they'll send a sales exec by quarterly to do what I call a health check. Make sure that big client is happy and is getting the functionality they want, right, out of the software. That is a customer market facing physical activity in that state. That's a Nexus trigger if it's beyond de minimis.
So we've got a good question here in the chat. If you don't have an address on the contract, then what would be some next supporting documents or documentation?
Yeah.
Is that something you see?
Yeah, and I don't know how to interact directly here, but the hierarchy, if you don't have a contract address, it's going to be the billing address would be next in the hierarchy. I've got clients that sell e-commerce clients and some smaller SaaS where it's B2C and it's credit card swipes.
Mm-hmm.
And they're using, I don't know, Stripe or whatever. And some of them don't have customer addresses. They don't even have credit card addresses. That would be also, well, what do you have? We don't have a contract address. We don't have a billing. We have a credit card address. That's a billing address. You have to go with what you have. At the very bottom of that hierarchy, it reverts back to the seller's location, but that's never used. I'm referring here to the streamlined sales tax, the SST sourcing hierarchy. And if you go to buy something at Best Buy, that's going to be the address. If you ship it to Florida, it's going to be shipped to Florida. If you don't have that, but there's a contract address, it's that. If you don't have that, but you have a billing address, it's that. That's going to be the hierarchy. They're never going to acquiesce and say, well, if you don't have any of that, it's the location of the seller. And well, we're in California and SaaS isn't taxable here, so we don't have any liability anywhere. Nah, that they'll find, well, we're going to dig into your IP address and find where that customer is, or do some sort of forensic exam if it's worth their. I'm exaggerating,
Yeah.
but I'm just saying that hierarchy is not going to be used for SaaS. That
Would
default.
you be able to use like a population methodology just to kind of get out of economic nexus in some of these jurisdictions? I know it's used for income tax nexus.
Yeah, for apportionment purposes,
Yeah.
income tax maybe. I think as Nick, that's a good example. When I just said, well, we don't have any of that, so it's going to revert to our address here in California, no tax. Yeah. I think Washington would say, yeah, well, we're going to take a piece based on population. The problem with that is, though, and I know we're running out of time, there's so many issues here. Okay, I get it, Malcolm. We're getting larger. We're going to do a study. We're going to get compliant. That means you have to implement some sort of compliance infrastructure and software, right? But what if you're one of those companies, and it's not as common with SaaS, right? Because you have a contractor, an MSA, usually. Even if it's smaller stuff, you have a credit card address at least. But that's the next question. Well, we don't have that information. How are we going to deal with that going forward? How do we know what to collect tax on? You can't use a population-based thing. I don't even know what address this is. Am I going to put 45 different states based on population? You know,
yeah, I kind of meant, I mean, yeah, of course, you're absolutely right. But maybe getting out of like proving, maybe, you know, just thinking out loud here, proving an auditor that, you know, yeah, it's a huge contract. We don't know where the people are.
For prior periods.
Yeah, for prior periods,
right.
We're not going to trigger economic nexus in these states. And I don't know. It's just something to think about. This is a complicated area.
Well, it's something you don't want to think about until there's an auditor at the door. And then it's like, look, I don't have time for this auditor. I've got other things to do. Oh, you'll make time. Or they'll issue a Jeopardy assessment. And then you're like, whoa. That's when they call me, right?
Right. So,
hey guys, well, I just want to interject here. I know we're running out on time. We got one more poll question in here, which I think Malcolm could maybe help tie this whole thing around to really, you know, what you could actually help with here in terms of on the ground tactics. So I'm going to launch this out here, and just want to know from everybody when the last time was that you performed a Nexus and or a taxability evaluation.
While we're waiting for that to populate, I would just say from a practical standpoint, you're saying we have customers, we don't know where they are. That's kind of a curious thing to me. I can't imagine that would be a best practice, and it would probably be in your best interest to try to figure out where your customers are. So,
well, I mean, in the world of crypto, though, you oftentimes don't know where they are, right?
Yeah,
and so, and in fact, I mean, it's an example that we used in California, at least for an income tax issue, and sort of waived the liability, income tax liability, that is, and we used the justification, and we used population, and we were able to bring the whole global world population, you know what I mean? And they accepted the FTB accepted that methodology, and the client won, but you know, in terms of sales tax, and I don't know.
Well, here I got our results here from the poll. Just want to share these really quick because I think there's a few of you that probably need to get in contact with Malcolm here after today. So, you know, many of you 2022, 2021, it's the last time you performed that taxability or Nexus evaluation, but seeing about 30% here says I don't know or never. So that's the case with you, Malcolm. I don't know, you're going to be able to speak to that a lot better than I, but I would imagine it's probably about due time then for some of those folks.
depending, right, where they are in their life cycle. That's how we open the presentation. It depends on where you are in your life cycle. You've got priorities, cost, benefit, opportunity cost. And if you're a CFO and you're not even $1 million in revenue and you want to do a Nexus evaluation, there's probably a misplaced priority there, in my opinion. I know that's heresy for a CPA not to want to get work from a client, right? But I'm an old guy, so I don't care.
There
But
you go.
I
It's
did see it.
practical. It's practical, but you also want to be looking ahead, right? It's, as I was saying before, it's like you don't want to be in 2 years from now and say, oops, now I'm 10 million and I forgot to do this. And, you know, it's the advanced planning, you know, what's the Wayne Gretzky skate to where the puck is going to be? You know, you want to be thinking ahead a little bit here. Where do you want to go?
I don't have too many SaaS clients that are stagnant, right? They're usually growing pretty fast, so it can get away from you quickly. Very quickly, Corbin, I see your comment very quickly. There are cities in Colorado that are home rule cities, just like the city of Chicago, that administer their own taxes. Illinois and Colorado don't tax SaaS, but those cities do. So, you know, I mean, I've got maybe not as much Colorado, but I've got clients with a lot of revenue coming out of Chicago contracts. So that's just another one. Good catch there, Corbin.